The United States, long the anchor of the global financial system, is navigating a complex and increasingly precarious economic landscape. Following a period marked by aggressive trade policies, including a wave of tariffs initiated by the previous administration that impacted nearly 80 nations, from strategic rivals like China to long-standing allies such as Canada and Mexico, the nation has begun to experience significant economic and geopolitical blowback. While proponents argued this strategy was necessary to address historical trade deficits and protect domestic industries, the unilateral approach has inadvertently undermined global confidence in the predictability and reliability of American economic policy. By pivoting away from multilateral engagement toward a protectionist and isolationist posture, Washington has damaged its reputation as a stable global partner. This reputation for stability was, and remains, the bedrock of American financial hegemony. For decades, investors, sovereign wealth funds, and central banks worldwide have confidently held vast portions of their foreign exchange reserves in U.S. Treasury securities. These assets, now totaling over $36 trillion, have historically been viewed as the safest investment in the world, the ultimate risk-free asset. However, the recent volatility and perceived unpredictability in American foreign and commercial policy are now prompting a fundamental reassessment. Governments and major financial institutions are actively diversifying their reserves, a move that is gradually but perceptibly reducing the global dominance of the US dollar. Concurrently, the market is demanding higher yields to compensate for the perceived increase in risk associated with holding US Treasury debt. This video delves into a critical yet often theoretical question. What would be the consequences if the world's major economies and investors significantly curtailed their purchases of US debt? Furthermore, how would the American economy, structurally dependent on this external financing, react to such a seismic shift?
To fully grasp the gravity of the current situation and the potential crisis the United States faces if it cannot stabilize the demand for its debt, it is essential to understand the historical trajectory that allowed the national debt to swell beyond $36 trillion. The origins of this fiscal expansion are deeply intertwined with the post-World War II global financial architecture. The critical turning point can be traced back to the collapse of the Bretton Woods system. Established in 1944, this agreement sought to stabilize the global economy by creating a system of fixed exchange rates, with the US dollar at its center. The dollar was the only currency directly convertible to gold at a fixed rate of $35 per ounce. All other participating currencies were pegged to the dollar. This arrangement effectively cemented the dollar's status as the world's primary reserve currency and the foundation of international trade. However, the system contained a fatal flaw, known as the Triffin dilemma. To meet the growing global demand for dollars, necessary for international trade and as reserve assets, the United States had to run persistent balance of payments deficits. This meant issuing more dollars than could be credibly backed by its gold reserves. As other nations accumulated massive dollar reserves, they grew increasingly concerned about Washington's ability to maintain the gold-dollar parity. This structural weakness was exacerbated by massive increases in U.S. public spending, particularly during the Vietnam War, and the expansion of domestic social programs in the 1960s. By the early 1970s, the military budget alone consumed a staggering portion of the national expenditure. The combination of high deficits from currency issuance and the economic strain of the war led key allies, notably France and Germany, to lose faith. They began demanding gold in exchange for their dollar holdings, rapidly depleting U.S. reserves. The crisis of confidence culminated in August 1971, when President Richard Nixon unilaterally suspended the dollar's convertibility to gold, effectively ending the Bretton Woods system. This move ushered in the era of fiat currency, where the dollar's value was no longer tied to a physical commodity, but was instead determined by market demand and the full faith and credit of the U.S. government. Crucially, the new fiat system removed the inherent fiscal discipline imposed by the gold standard. The United States gained unprecedented freedom to print money and expand public spending without the immediate constraint of gold reserves. The national debt, which stood at approximately $570 billion in 1975, skyrocketed to over $3.3 trillion by the early 1990s. This exponential growth was manageable because the U.S. successfully negotiated the petrodollar system, ensuring global demand for the dollar remained high as the currency of choice for oil transactions. Foreign nations, particularly oil exporters, continued to accumulate vast dollar reserves, which they recycled back into the U.S. economy by purchasing Treasury securities. This mechanism not only stabilized the dollar's value, but also provided a continuous, low-cost source of financing for the ever-expanding U.S. government budget.
The issue of national self-indebtedness entered a new, more acute phase following the 2008 global financial crisis. This crisis, the most severe since the Great Depression, was rooted in systemic failures within the U.S. banking sector, specifically the issuance of massive volumes of subprime mortgages to borrowers with poor credit histories. The subsequent wave of defaults led to the collapse of the housing market, the devaluation of mortgage-backed securities, and the near failure of numerous major financial institutions. The government's response was swift and unprecedented in scale. To prevent a total collapse of the financial system, the U.S. Treasury and the Federal Reserve implemented massive intervention programs, including the Troubled Asset Relief Program, TARP, and extensive quantitative easing, QE. Hundreds of billions of dollars were injected into banks and the broader economy to restore liquidity and confidence. While these measures were arguably necessary to avert a second Great Depression, they came at a colossal cost to the national balance sheet. As the government spent trillions to revitalize the economy, the national debt surged. In 2009 alone, federal spending exceeded revenues by over $2 trillion, marking the beginning of a sustained period where the United States consistently spent far more than it collected. This imbalance was driven by a combination of factors: the need to maintain social welfare programs, the costs of ongoing military engagements, and the sheer expense of servicing the rapidly growing debt itself. The military sector in particular continues to represent a disproportionate share of global military spending, consuming a significant portion of the annual budget. This new era of chronic fiscal imbalance has culminated in the national debt reaching approximately $36 trillion, representing about 120% of the national GDP. The U.S. government manages this debt through a continuous cycle of issuing new Treasury securities, T-bonds, T-notes, and T-bills to pay off maturing debt and finance ongoing expenditures. This mechanism, while effective at preventing immediate default, creates a perpetual and escalating cycle of indebtedness where the country is constantly borrowing to pay its creditors. The critical question now is the sustainability of this model, particularly in the face of growing geopolitical tensions and a global trend toward de-dollarization. The possibility of a significant reduction in demand for U.S. debt, once considered remote, is becoming increasingly real. The dollar's share in global international reserves has been steadily declining. This trend is not accidental. It is a calculated strategy by several major economies to reduce their vulnerability to U.S. foreign policy and economic sanctions. The weaponization of the dollar, specifically the use of sanctions to freeze the assets of foreign central banks and exclude nations from the SWIFT international payment system, has served as a powerful catalyst for diversification. Nations now view their dollar holdings not just as a financial asset, but as a potential liability subject to political risk. China, for example, remains a massive holder of U.S. debt, but its strategy has clearly shifted. Following years of trade disputes and escalating geopolitical rivalry with the U.S., Beijing has actively sought to reduce its exposure. The dollar's participation in China's international reserves has fallen significantly, and the country has been systematically reducing its holdings of U.S. Treasury securities. In recent months, China's holdings have dropped to their lowest volume since 2009, despite the country remaining the second largest foreign investor in U.S. debt, after Japan. Over the last decade, China has divested over $550 billion in U.S. treasuries, a clear signal that this trend is likely to continue as it seeks to diversify into other currencies and historically safer assets, such as gold. Indeed, China has been one of the world's largest purchasers of gold, adding substantial tonnage to its reserves as a hedge against dollar volatility and political risk. Beyond China, other factors are contributing to the reduced appetite for U.S. debt. Rising currency protection costs, the increasing volatility of the dollar and the global economy means that foreign investors must spend more to hedge their currency risk, making U.S. debt less attractive on a net return basis. Geopolitical tensions. Washington's assertive stance in international affairs, including the imposition of tariffs and the threat of sanctions, creates an environment of economic uncertainty that increases the perceived risk associated with American economic policy. The rise of alternative blocs. The BRICS group, Brazil, Russia, India, China, and South Africa, with recent expansions, has been a vocal proponent of de-dollarization, actively promoting trade agreements settled in local currencies and exploring alternatives to the dollar-centric payment system. This maneuver directly weakens the demand for U.S. Treasury securities and challenges the dollar's status as the global reserve currency.
If the demand for U.S. debt were to diminish significantly, the United States would face a fiscal shock of unprecedented magnitude. The current model relies on a continuous supply of external capital to finance the government's massive spending and deficits. Without the support of foreign creditors, Washington would be forced to make drastic, painful choices. The immediate consequence would be the need to raise interest rates dramatically to attract domestic and remaining foreign buyers. While a sharp rate hike might temporarily contain inflation and strengthen the dollar, it would also have devastating effects. Soaring debt service costs. Higher interest rates would immediately and drastically increase the cost of servicing the national debt. Currently, debt service is already one of the largest items in the federal budget, rivaling spending on defense and education. A significant rate increase would quickly make debt service the single largest expenditure, crowding out funding for critical social programs, infrastructure, and military readiness. Economic slowdown and recession. Higher rates would translate into higher borrowing costs across the entire economy for businesses, consumers, and homeowners. This would stifle investment, reduce consumer spending, and likely trigger a severe economic recession, leading to mass layoffs and a sharp increase in unemployment. Loss of global standing. The inability to finance its debt at reasonable rates would signal a profound loss of confidence in the U.S. economy and its political system. This would accelerate capital flight and further weaken America's strategic position on the global stage. The dollar's status as the global reserve currency would be irrevocably compromised, accelerating the world's transition to a multipolar financial system where other currencies, such as the euro or the Chinese yuan, gain greater relevance in trade and international reserves. The structural challenges are compounded by domestic political dynamics. The use of tariffs and protectionist measures, while intended to boost domestic production, often leads to higher prices for consumers and businesses, fueling domestic inflation. This inflationary pressure forces the Federal Reserve to maintain or raise interest rates, which, as noted, increases the cost of debt service. This creates a dangerous feedback loop. Geopolitical tensions lead to trade wars, which lead to inflation, which leads to higher interest rates, which makes the national debt more expensive and harder to finance. Furthermore, the political environment remains deeply polarized. The prospect of future administrations advocating for policies like the One Big Beautiful Bill Act, which could include measures to tax foreign assets in the U.S., only increases uncertainty and further deters international investors. This political gridlock and unpredictability make it exceedingly difficult for the U.S. to sustain its deficits, as investors demand a premium for the political risk they are undertaking. The United States is at a critical juncture. The era of easy, low-cost financing for its massive deficits, underpinned by the unquestioned dominance of the dollar, is drawing to a close. The nation is caught between the imperative to fund its ever-growing expenditures, driven by a combination of social commitments, military spending, and debt service, and the increasing reluctance of the world to finance it. The current trajectory, marked by continuous political infighting and a failure to address the structural drivers of the debt, is unsustainable. The path to fiscal stability requires a concerted, bipartisan effort to achieve political consensus and implement long-term measures. These measures must include a credible plan to reduce the deficit, reform entitlement programs, and stabilize the national debt-to-GDP ratio. Failure to act decisively will not only mean a painful domestic economic adjustment, but will also fundamentally reshape the global financial order, permanently diminishing the economic and geopolitical power of the United States. The American public must understand that the cost of political gridlock is no longer abstract. It is measured in the rising cost of debt service, the erosion of the dollar's global standing, and the increasing vulnerability of the entire economy to external shocks. The time for a serious national conversation about fiscal responsibility is now, before the market forces the issue with a shock that could destabilize the global economy.
If you found this deep dive into the U.S. debt crisis insightful, make sure to hit the like button and subscribe to our channel for more in-depth analysis of global finance and geopolitics. We want to hear your perspective. What steps do you think the U.S. government should take to regain fiscal stability? Share your thoughts in the comments below. Thanks for watching, and we'll see you in the next video.